Welcome. Today we are unpacking a company that, on the surface, looks like your standard healthcare provider.
Hmm.
You see the name Lokman Hekim, and you think hospitals, doctors, stethoscopes, and you'd be right. But when you crack open their 2025 consolidated financial statements, you realize you're looking at something, well, much more complex.
It is a fascinating organism. We're looking at a healthcare provider, yes, but we're also looking at a university landlord, a tech investor, a logistics company, and this is the part I love, a dairy farmer.
I still can't quite get over the dairy farm part, but we will get there. We're decoding this for you, the retail investor, who wants to look past the stock ticker and really get under the hood of the annual report for the period ending December 31st, 2025.
And before we dive into the numbers, we have to make a crucial disclaimer. We're looking at these numbers through the lens of TS29. That's the accounting standard for high inflation economies.
Okay, let's unpack this immediately because it changes how we read every single line item. What does TS29 actually do to the numbers we're about to discuss?
Think of it like trying to measure a building while your ruler keeps shrinking every month.
Okay.
If you used last year's ruler to measure this year's building, the building would look gigantic. But it's an illusion. TAS29 adjusts everything. It restates the previous year's figures, in this case, 2024, into the purchasing power of December 2025.
So when we compare 2024 to 2025 today, we're making a fair apple-to-apples comparison.
Exactly. It's the only way to do it.
That is vital context.
Yeah.
It means if we see growth in this report, it's real growth, not just inflation noise.
That's right.
Let's first get to know the company a little.
Right. Lokman, Hekim, Engürüsag, headquartered in Çankaya, Ankara. They've been around since 1996.
And instead of manufacturing plants, their factories are hospitals. They have a strong fortress in Ankara with the Edlik and Ake hospitals.
Mm-hmm.
And they have this interesting footprint out in Van with the Van and Hyatt hospitals. And they've moved into the highly competitive Istanbul market with the hospital in Pendik.
Exactly. But they aren't purely domestic anymore. And that is a key detail for the growth-oriented investor. They have a diagnostic center in Erbil, Iraq.
Right.
And looking at the 2025 notes, they've just acquired a 100% stake in a medical center in Bishkek, Kyrgyz Republic, specifically for PTCT imaging.
So they're exporting Turkish healthcare expertise to markets where that high-level diagnostics might be scarce. That's smart. Now, let's talk about the subsidiaries, because this is where that conglomerate feel comes in. Obviously, the core is healthcare.
Yes, roughly 84% of their revenue comes strictly from health services. That is the engine.
Okay.
But to support that engine, they have Lokman Hekim Logistic. This subsidiary handles laundry, cleaning, catering, basically the logistical backbone of the hospitals.
It makes sense to keep that in-house.
Yeah.
Control quality and cost. But then you have the digital side, Hekim Health, everywhere.
This is their play on digital transformation. It's a platform for appointments, comparing services, telemedicine. They're trying to capture the patient journey before they even step into the physical hospital. It's about owning the funnel.
And now, the curveball. Haysit, live being and milk production.
Yes. They operate a facility in Ankara, the Heymana and Bala districts. They are producing milk and livestock.
I have to ask, from a strategic standpoint, why is a hospital group selling milk?
It is a unique diversification strategy. You could argue it's about health in a holistic sense, nutrition. But financially, look at it as a biological asset class. In an inflationary environment, food prices rise.
So owning the source of food production acts as a hedge.
It's a hedge that moves. It generated over 93 million Chiriy in revenue in 2025. It's not just a hobby farm, it's a real business line.
Incredible. So putting it all together, they have a workforce of 2,426 people. That's up from the previous year. And that includes 278 doctors.
Which is a critical metric. In healthcare, your production capacity is, it's capped by your number of physicians. Increasing that number suggests they're scaling up capacity to treat more patients.
Let's look at who's running the show. The shareholding structure.
This is a classic dual-class share structure that investors really need to be aware of. You have Group A shares and Group B shares.
Right.
And Group A holds less than 1% of the capital.
Less than 1%.
Yes, 0.81% to be exact. But that tiny sliver has the privilege of nominating the majority of the board of directors. The Group B shares, that's the 99.19% held by the public and others, have no such privileges.
So retail investors are along for the ride, but the strategic control sits firmly with that Group A.
You've got it. You own the equity, but not the steering wheel.
Speaking of the people at the wheel, I saw the executive compensation figure.
Yes, the benefits provided for executive management. It totaled about 47.9 million Rye for the year. That's actually down slightly from 52.9 million in the previous period in real terms.
So some cost discipline at the top.
It seems so, yeah.
Before we get to the money, let's look at where they sit in the market. Who pays the bills?
This is one of the most significant shifts in the report. Historically, Turkish private hospitals rely heavily on the SSI, the Social Security Institution. But look at the revenue split for 2025.
I'm seeing, 18% from SSI?
Exactly. Only 18%. That means 82% of their health revenue is coming from private individuals and private insurance.
That seems like a massive pivot.
It is. It means they have pricing power. They are not entirely at the mercy of government-set prices. They're attracting customers willing to pay out of pocket or who have private coverage. That's a much healthier margin profile, usually.
And it insulates them from regulatory price caps.
Precisely.
So if we were to do a quick SWOT analysis here, strengths.
Strengths. Diversified geography, Ankara, Istanbul, Van. The university affiliation, which we'll get to, adds prestige and a talent pipeline. And the JCI accreditation in Istanbul is a global gold standard for quality. Financial expenses, they are heavy. And despite the shift, they're still somewhat dependent on the regulatory environment of the SSI for that base volume of patients.
Opportunity.
Health tourism. That foothold in Iraq and Kyrgyzstan isn't just for locals. It's a funnel to bring complex cases back to Turkey. And the digital health platform lets them scale without building new walls.
And the big one, threats.
The economy, inflation, and as we're about to see in the numbers, the cost of debt.
Now we can move on to our analysis. Let's look at the numbers.
Let's start with the top line, revenue.
They brought in 4.23 billion TRY. That's up from 3.85 billion in 2024.
That is solid real growth. And if you break it down, health is king at 3.5 billion. But look at the hospital rental income.
374 million TRY. That is almost 9% of their total revenue. They're making more from rent than from milk.
Much more. And this is because of the Lokman Hekim University connection. They rent their Ankara hospital building to the university. So in a way, they're a real estate investment trust disguised as a hospital operator.
That is a fascinating hedge. Okay, so revenue is up. How about profitability?
Gross profit increased to nearly 750 million TRY. Operating profit is also strong at 525 million. Operationally, the core business is healthy.
Right.
They're treating patients, selling services, and making money on those services.
But here's where it gets really interesting, or maybe worrying. I'm looking at the net profit.
The bottom line.
It dropped significantly from roughly 313 million TRY in 2024 to 150.3 million in 2025. That is more than a 50% drop in real terms.
And the earnings per share, the EPS, followed suit. It fell from 1.45 TRY to roughly 0.70 TRY.
So the company is selling more, operationally doing well, but shareholders are taking home half as much. Why?
It is the interest monster I mentioned earlier. Look at the financial expenses line item. 500 million TRY.
$500 million lira in finance costs.
Yes, the cost of borrowing money is eating the operational profits alive. In a high-interest rate environment, carrying debt becomes incredibly expensive.
And taxes played a part, too.
They did. A shift in deferred tax expenses weighed them down this year compared to the last one.
Let's talk about that debt. Because when I look at the liabilities, I see something new. A sukuk?
Yes, the issued borrowing instruments. This is a massive line item, 1.09 billion TRY. This is a lease certificate, often called a sukuk in Islamic finance.
For the listener who might not be familiar, how does this differ from a regular bank loan?
Well, in practice, it functions similarly to a bond. Investors give the company money for a certificate, and the company pays rent or profit share back to them. It's an alternative to traditional interest-based banking.
And this wasn't there last year?
No. Last year, this line was zero. At the same time, their short-term bank loans dropped significantly.
So they did a debt swap.
It's a debt swap. They replaced traditional bank loans with this sukuk issuance.
Why would they do that?
It could be about diversifying funding sources, maybe banks were tightening credit lines, or maybe the sukuk offered access to a different pool of capital. But make no mistake, it is short-term debt. It needs to be paid back or rolled over quickly.
And the cost. What is the interest rate on this thing?
The weighted average interest rate mentioned in the notes is 46.6%.
Ouch. 46.6% interest. No wonder the finance expenses are 500 million.
Exactly. When you are paying nearly 50% interest, you have to run extremely fast just to stay in the same place. It turns the business into a treadmill.
What about their cash position? Can they afford this treadmill?
Cash and equivalents actually increased to 164.2 million TRY, and their operating cash flow is positive at 271 million. So the business does generate cash.
But I see a huge number under investing activities.
A massive outflow. 937 million TRY spent on investing activities. This tells us they are in an aggressive growth phase. They are not hoarding cash, they are pouring it into tangible assets, buying equipment, upgrading buildings.
And property, plant, and equipment jumped to 2.48 billion TRY.
Part of that is the inflation adjustment revaluing the assets, but a big part is new investment. They're betting that this expansion, like the Kyrgyzstan Center and the Istanbul operations, will generate enough future return to pay off that expensive debt.
Let's look at equity.
Total equity is around 2.59 billion TRY. It decreased slightly in real terms, mostly due to the lower net profit and dividend distributions.
But they've been doing some financial engineering too, right? Share buybacks?
They have been very active. They repurchase shares, which signals they believe the stock is undervalued. But then, interestingly, they sold a chunk of them, about 6.6 million shares in early 2026 for a profit.
So that boosted their equity reserves.
Exactly. It shows management is actively trading their own stock to manage capital.
I want to zoom in on a few specific details from the footnotes. You mentioned the university connection earlier.
This is critical for the learner investor to understand. It is a related party transaction. They rent the building to the university, which generates income, but they also have high receivables from the university.
Receivables means money the university owes them but hasn't paid yet.
Exactly. Trade receivables from related parties jumped to over 182 million TRY. When your biggest customer for rent is a related party and they owe you a lot of money, it's a risk factor. It's not an arm's length transaction.
So if the university has a cash flow problem, Lokman Hekim has a cash flow problem.
That's the risk in a nutshell.
That's a crucial nuance. And back to the cows.
The biological assets. The fair value of their livestock increased by roughly 77 million TRY.
So inflation makes the cows worth more.
Essentially, yes. As food and meat prices rise, the value of the herd rises. It's a tangible asset that appreciates with the cost of living.
I love that. An inflation hedge that moves. One other thing caught my eye, litigation.
A red flag, potentially. Provisions for lawsuits jumped from about 4.9 million to 20.6 million TRY.
That is a big jump.
It is. In the grand scheme of billions in revenue, it's manageable. But a 4 times jump in legal provisions suggests they're facing some headwinds, maybe malpractice suits or labor disputes. It is something to watch in the next report.
So what does this all mean? If I'm sitting here looking at Lokman and Hekim, what is the story?
The story is growth at a cost.
Explain that.
On one hand, you have a company that is expanding its top line. Revenue is up, they're diversifying into tech and foreign markets, they're shifting to private pay customers, which is smart. They have huge asset backing in real estate and, well, livestock.
Right.
But the cost of that growth is high leverage in a high-interest environment. They're paying a fortune to service their debt. That Sukuk issuance keeps them liquid, but it's very expensive capital.
So the profit margin is getting squeezed between operational success and financial burden.
Precisely. For the retail investor, the question is, can they grow fast enough to outrun the interest payments? If inflation cools and interest rates drop, Lokman Hekim is poised to explode in profitability because that interest burden will vanish.
But if rates stay high?
Then that 500 million TRY finance expense continues to eat the shareholders' lunch.
It really highlights the difference between a good business and a good investment. The hospitals are busy, the logistics are running, the milk is flowing, but the financial structure is under pressure.
And don't forget the real estate angle. A significant portion of their value is locked up in the buildings they own and rent out. You are buying a healthcare operator, but you're also buying a property portfolio.
That is a great way to frame it.
And one final note on the free cash flow. Because they are investing so heavily, almost $1 billion lira outflow, their free cash flow is negative. They are burning cash to build the future. That is fine if the future pays off, but it is risky.
It is definitely not a stock for the faint of heart or for someone looking for a steady, boring utility. It is a complex, moving beast.
A beast with hospitals, trucks, apps, and cows.
Just a fascinating mix. Before we wrap up, I want to leave the listeners with a thought. We talked about the shift to private patients. We talked about the debt. But think about the integration.
Go on.
Is Lokman Hekim a healthcare provider that happens to own property, or are they slowly becoming a property company that happens to employ doctors? And with the dairy farm, Are they hedging against health risks with milk?
It raises the question of focus. Conglomerates often suffer from a conglomerate discount because investors prefer focus. But in a volatile economy like Turkey's, maybe this diversification is actually a survival mechanism.
Hmm.
If the hospitals struggle, the rent gets paid. If the rent drops, the milk sells.
An ecosystem of survival. That is a provocative thought.
Indeed, it forces you to ask, what are you actually buying when you buy this ticker?
Exactly. And that is why we dive deep. If you enjoyed this breakdown and want us to decode more financial statements, please hit that like button and subscribe to the channel. It really helps us out.
And share this with your investor friends. The more we learn together, the better decisions we make.
We also invite you to evaluate our channel membership. It supports ongoing videos and keeps the lights on here at the Deep Dive.
And if you found specific value in today's analysis, consider using the Super Thanks feature.
Thanks for diving deep with us. Until the next report.